First aspect is decoding of income statement, or it is, as we all know, it is also known as profit and loss statement. Now, firstly, I'm going to discuss with you the profit and loss statement from the perspective of financial reporting. And for your ease, what I have done, I'm going to divide the discussion on the profit and loss statement from the perspective of financial reporting into two parts, and we will go both the parts one by one. So this is the P&L which is prepared by the company, which is required to be prepared by the companies as per the accounting standards. And remember, at this point in time, if your company is listed, then you have to follow the Ind AS. If your company is not listed, then you have to follow the Indian GAAP. And we all know that any company which is listed on the stock exchange, then not only this company, but its subsidiary, its holding company, its joint ventures, its associates companies, to all of them, the application of Ind AS becomes mandatory. And if even if the company is not listed and the net worth of the company is more than 250 CR, in that case also Ind AS becomes applicable. To all the other companies, it is Indian GAAP which is applicable. So this is, and then of course, friends, we also have Schedule 3, and the Schedule 3 has got three divisions. Division 1 is for the companies to which Ind AS is not applicable or to which Indian GAAP is applicable. The Division 2 is for the companies to which Ind AS is applicable, and the Division 3 is for the companies which are into the insurance, banking and other sector, and to them it is Division 3 which is applicable. So the format of the profit and loss statement as per schedule is as we can see on the screen. Let us look at them one by one. So firstly, we will look at the first part. So what the P&L will comprise of? Number one, it will comprise of the revenue from operations. We all understand. So Maruti is into the business of making cars. So the revenue that they generate from the sale of the cars, it is going to be part of their revenue from the operations. Then the company may also have some other income incidental to their operations, and that will be that is given in the P&L statement as other income. And then you have a figure of total income. After the total income or total revenue, then what you have the expenses. Under the expenses, the first expense that is there, it is cost of material consumed. It does not need any elaboration, we all understand. So a manufacturing company will use raw material, so the cost of the raw material will appear here as cost of material consumed. Thereafter, you see an item called purchase of stock in trade. Now what does it mean? It simply means it is possible that a company is not only doing the manufacturing, but it also has to sell some of the components, and which really is not a manufacturing activity, which is a trading activity. So in case if a company is also engaged in trading activities simultaneously, then whatever material it would have purchased, it would come under the heading purchase of stock in trade. Please remember, if the company is not into the trading, in that case this line will not appear in the P&L statement. After that, you will see a line item called changes in inventories of finished goods, work in progress and stock in trade. Now what this item is, and this is where you need to pay little attention. See, whenever a company is manufacturing, that company will have put the raw material on the production floor. That raw material would have been converted into work in progress or in the finished goods. Now, if it is possible that the material cost which has already been taken in the P&L statement, part of that material has not been really consumed. Rather, it is lying in the form of work in progress or the finished goods. So therefore, you will see this figure is minus. So when this figure is minus, that means what? That means it shows that the WIP has gone up and the finished goods has gone up. That means the raw material which has been consumed has not really gone out. It is still lying on the shop floor, and this is the net effect of this is that the material cost of the cost of the material consumed is reduced accordingly. The next item that you see is the manufacturing expenses. Now, please remember what is manufacturing expenses. Manufacturing expenses are the expenses that a business would incur for converting the raw material into finished products. And that is what is known as manufacturing expenses. Now please remember, manufacturing expenses is also referred as conversion cost. And why it is also known as conversion cost? No rocket science. It is also known as conversion cost because this is the cost that you are incurring for converting raw material into the finished product. And that is why whatever cost that you incur will appear here as manufacturing expenses. After the manufacturing expenses, what you have something which is employee benefit expenses. And I'm sure you can very easily understand what does it mean. It means all the expenses, all the costs which are incurred by a company on the employees, that is your employee benefit expenses. So it will include salary, it will include perquisites, it will include allowances, it will include provident fund contribution by the company, superannuation contribution by the company, gratuity contribution by the company, leave encashment, staff welfare expenses. So all the expenses that a company would incur on its employees, that is recorded in the P&L as employee benefit expenses. After that, you have other administrative expenses. Now, what is other administrative expenses? It is really speaking selling, general and administrative expenses. So in other words, administrative expenses which we see in the financial statement in the P&L appearing. Now what does it comprise of? It comprises of all the expenses other than the material cost, all the operating expenses other than the material cost and the manufacturing expenses. So all the expenses that a company would incur on the administration, marketing, selling, distribution, all those expenses will be part of the administrative expenses. So that is also known in other words as selling, general and administrative expenses. But remember, as per the format given in the schedule 3, what the term which is to be used is other administrative expenses. Sometimes I have seen some people also just write other expenses, but basically both mean the same thing. After that, what you have depreciation and amortization. Now we all understand depreciation very well. Some of us may have some confusion about the amortization. What is amortization? Let me tell you, friends, what is amortization. So in business, there are two kinds of the assets that we use in our business. Number one, we use the assets which are tangible, and number two, we use the assets which are intangible. And we all know the examples of tangible assets would mean building, plant and machinery, computer, furniture, so on and so forth. And the examples of intangible assets would include technical know-how, brand name, logo, design, software. So these are all examples of intangible assets. So how do you differentiate between the tangible assets and the intangible assets? Just to give you a quick definition, tangible asset is one that we can touch, we can feel and we can see. That is tangible assets. Contrary to this, intangible assets are those assets that we cannot touch, we cannot feel and we cannot see. And this is the difference between the tangible assets and the intangible assets. Now, doesn't really matter whether an asset is tangible or intangible. The fact that we are using it in our business, the value of these assets is going down. Meaning what? Meaning reduction in the value of a tangible asset is known as depreciation, and reduction in the value of an intangible asset is known as amortization. So this is the simple difference between the depreciation and in amortization. If I can put it in simple words, I would say what depreciation is for tangible assets, amortization is for intangible assets. So this is how one can differentiate and understand. I would also like to mention at this point in time that please remember depreciation and amortization are also non-cash expenses. And why they are non-cash expenses? No rocket science. They are non-cash expenses because on account of depreciation, the business does not give money to anyone outside. On account of amortization, the business does not give money to anyone outside. So even though we deduct the depreciation and amortization as an expense from the income that we have earned in our business, but this money is not given to anyone. Ultimately, that money is remaining in the business only. And that is why depreciation and amortization is also known as non-cash expense. Now, after that, what we have finance cost or the interest cost. Please remember, whether you call it a finance cost or you call it interest cost or you call it borrowing cost, all of them mean the same thing. And what the finance cost or the interest cost or the borrowing cost is, it is nothing but the interest that you pay or the financial charges that you pay on the loans that you may have taken. Please remember, you may have taken loan for a project, you may have taken loan for working capital. Irrespective of what is the purpose for which you have taken the loan, the interest you will pay, and that interest will appear in the P&L, appears in the P&L statement as finance cost, interest cost, borrowing cost, or finance charge. They all mean the same thing. So now what you have, now you have all these expenses together here, all the expenses together here, and you have here all the revenues together. So from the revenue, when you minus the expenses, what you get in your hand, it is known as profit before extraordinary items and tax. It is known as profit before extraordinary items and tax. Now let us understand what is the meaning of extraordinary item. Of course, in this statement that I am discussing with you, I have not taken any extraordinary item to keep it simple. But let's understand what is extraordinary item and why it has to be shown separately. That is what we as the company secretaries must understand. Remember, the purpose of profit and loss statement is to show the real profitability performance of a business, profitability from the operations, not the total profitability uh, to show the profitability from the operations. So what can be an extraordinary item? So let me just tell you, extraordinary item is an item which is not an ordinary item. Now what does it mean? It means ordinary items are the ones that occur in the business on a regular basis. So we purchase material, we make production, we sell the goods, we receive money, we incur expenses, OPEXs on salary, travel, communication, and so on and so forth. Now these are all the routine expenses, and that's how they are ordinary expenses. But there are times in a business when a business can have extraordinary items of income or expense. Say for example, there is a fire in the plant of the company. So because of the fire in the plant in the company, there's a loss that has occurred. Now the loss occurred is, let's say, of 1 crore. Insurance company is reimbursing 80 lakhs. So the company has still suffered a loss of 20 lakhs. Now please tell me, is this loss of 20 lakhs that the company has suffered after adjusting the reimbursement that the company has got from the insurance company, is it an ordinary expense of the company or it is an extraordinary expense of the company? Obviously it is an extraordinary expense of the company. That means this is not something which is going to happen every year. This is once in a while, and therefore this item of extraordinary expense need to be shown separately so that the profitability picture of the business doesn't get distorted. Likewise, an example of extraordinary income. So it is possible that the company had a piece of land lying somewhere for many years, and suddenly for some reason company decides to sell that piece of land to someone, and on the sale of that land company earns a profit, let's say, of 5 crore. Now this profit of 5 crore which the company is earning, is it the ordinary item of the company? Answer of course is no. This is not ordinary item, this is an extraordinary item. So should it be shown as part of the income from the operations, or should be shown at a different place or separately? Obviously it has to be shown separately. Why it has to be shown separately? Because if this 5 crore was to have been included in the revenue from the operations, the reader of the balance sheet will get the impression, a very flowery impression about the company's operations, because the operations, the figure of operation is inflated because of the profit that the company has earned on the sale of land. So therefore, all the items, all the ordinary items have to be taken and shown separately so that the P&L of the business shows a correct picture of the company. So what you do, you will take the profit before extraordinary items here, and from the profit before extraordinary items and tax, you will adjust. So if there is a profit, you will add it. If there is a loss, you will minus it from there. And what you get in your hand now, that is known as PBT, profit before tax. Profit before tax. Now it is from the profit before tax you will minus the tax expense. So remember, the tax expense in case of a business can be of are of two type, or one is current tax and second is deferred tax. Now for the tax purpose, there is a separate accounting standards under the Ind AS also and under the Indian GAAP also. A question may come to your mind as to where is the need of showing or breaking the tax of a company into two components as current tax and the deferred tax. So remember why the concept of deferred tax, and that is because many times it happens that the, or rather invariably it would happen that the profit as per the books and the profit as per the income tax will never meet. And why they will never match? And that is because of two reasons. Number one, there are timing differences in certain items of income or expenses, and there are permanent differences in respect of certain item or expenses. As a result of that, what happens that the tax liability under the income tax is not same as it would work out as per the P&L prepared based on the Companies Act provisions. And therefore, to reflect the correct situation, uh, it is possible that because of some extra depreciation that the company has got in the current year, because of the extra depreciation the company has got in the current year, or because of the carried forward losses that the company has got in the current year, or because of merger of a loss company into the company has got some tax benefits advantage available in the current year. So what is going to happen is, even though the tax liability of the company is let's say 100 crore, but because of the carried forward losses, or because of the losses of a loss making company which is merging into this entity, or because of the timing differences, the current tax liability which is payable to the government is coming 20 crore. And therefore the difference 100 crore minus 20 crore is shown as a deferred tax expense. Now please remember why it is shown a deferred tax expense. That is because this tax company is not paying today, but it does not mean that the company is not going to pay it forever. The company will have to pay this tax going forward, whenever they make profit in future. So to show a correct picture of profitability, you have this concept of current tax and the deferred tax. You can imagine if this deferred tax was not to appear here, then the entire profitability of the business would have undergone a change. Suddenly your profit would look more rosy, more attractive, and that would really be giving a wrong picture. And that is why you have the accounting standards on income tax, and that requires that the tax needs to be broken between the current tax and between the deferred tax. Now from the figure of profit before tax, you deduct your total taxes, and what you get is profit or loss for the period from the continuing operations. Now let me also tell you what does it mean. Now, why there is why this line item profit from the continuing operations. Remember friends, today the business world is very dynamic, as we all are seeing day in and day out. There are so many mergers happening, takeovers happening, acquisitions happening, demerger happening, company selling their units, company buying somebody else's unit. So if a company decides to dispose of a division of this company, and that means this division is no longer going to be continuing with the company, but until the time this division is finally sold, this division is going to be run also. So the profit which is going to be profit or losses which are going to be earned from this division will need to be shown as profit from the discontinued operations. And that means what? That means when you as a reader of the profit and loss statement, when you look at this item in the bottom, there is something called profit from the discontinued operations. So you will understand that this amount of profit is not going to be available to the company in the times to come. And therefore, if you have to take a decision based on this P&L, what you should do, you should ignore this profit which is going to accrue to the company from the discontinued operations. So you will first take the profit from the continued operations, and then you will add the profit from the discontinued operations. Please remember, the profit from the discontinued operations got to be shown net of taxes. So either you can directly show a net of taxes, so the net profit from the discontinued operations, or you can show the profit from the discontinued operations and then you deduct separately the tax applicable to that to the profit which is earned from the discontinued operations. Then you may have some other comprehensive income. And what are the other comprehensive income, friends? It is very simple, no rocket science. The meaning of other comprehensive income, or OCI, is there are certain gains that accrue to a business which are unrealized at the time of closure of the financial statements. So now these unrealized gains, if you account them into your profitability, it is going to give a wrong picture, because these unrealized gains, remember, you are not sure as to how much they will be finally. Say for example, you have entered into a forward contract, or you have entered into a derivative transaction. So it is possible on the date of the balance sheet you may have earned something on that, but the something which has which is already become due. Now it is quite possible that you may not realize this amount finally when that forward contract comes to a close. So therefore, until the time the gain or the loss on such transactions are closed, they are to be shown not as part of the P&L. They are to be shown separately as OCI, other comprehensive income. Other comprehensive income. So in future, whenever the change happens, so you will accordingly account for. So the total of all of them put together, friends, comes in the balance sheet, and that comes as your profit and loss for the tax for the year. Now, it is this profit after tax, profit or loss after tax, which goes to the balance sheet. Now here we need to remember, before this figure is taken to the balance sheet, in case if the company is paying a dividend, then that amount of dividend will need to be deducted from this profit, and the net profit or earning after tax or profit after tax minus the amount of dividend that the company is going to pay, that figure will go to the balance sheet, and it will sit in the balance sheet as part of reserves and surplus. Why? Because reserves and surplus shows us what? It shows us the amount of profit that the company has flowed back into the business over the years. And thereafter, you will have two more line items appearing in the P&L statement that you would see. So one is your basic earning per share, and the second is your diluted earning per share. So what is basic earning per share? It is very simple. How do you calculate the basic earning per share? You will calculate the basic earning per share, or basic EPS, by taking the earning after tax and dividing it by the number of shares outstanding on the date of the balance sheet. So that is how you will calculate the basic earning per share, or basic EPS. How do you calculate diluted earning per share? And this is where, friends, we need to understand. So what is the meaning of diluted earning per share? So remember, it is possible a company may have issued certain convertible instruments. So a company may have issued convertible debenture, or company may have issued convertible preference share. Now, as a right approach of presenting the numbers to the shareholders, or to all the stakeholders who are interested in the reading of your financial statements, it is good to show, it is required, not good, it is required as per the accounting standard, to also show the diluted earning per share. Now, how do you calculate diluted earning per share? Just remember, very simple. So you calculate your earning per share of the current financial year, assuming all those convertible instruments are already converted. So if a company has issued convertible debenture, assume that the convertible debenture is already converted. So what will happen if the convertible debenture is already converted? Two things will happen. Number one, since it is a convertible debenture, it is converted into equity. Number one, your number of equity shares will increase. And number two, since the convertible debenture is already converted into equity, therefore your obligation for paying the interest will cease. So what you will need to do for calculating the diluted earning per share, you will have to make necessary adjustment in the profit which are available, which means you will add the profit on these debentures back to the your profit, and also adjust that amount of interest by the tax that you will have to pay. So then that is the amount which is available to you as profit after tax. So you have an increased amount of profit after tax available because the convertible debenture has been converted. Now, since the convertible debentures have been converted, now second thing that will happen, your number of equity shares also would increase. So, assuming that your debenture is your convertible debenture is converted into equity, interest obligation has become zero, number of shares have increased, and therefore taking the new profit after tax and the new number of shares, hypothetically you calculate your earning per share, and that is your diluted earning per share. So this is, friends, as far as the understanding profit and loss for the purpose of the financial reporting.